So we're live. I was just standing here awkwardly, staring into nothingness. Hey, everybody in internet world. Good to have you back. Hopefully we have almost as many people as we had earlier. I do get it that it's a Friday. Thank you for everyone who's here, who has stuck with us. Maybe you just don't want to go back out in the rain, or the ice cream that we had was keeping you around. But I'm glad we're still all here. We're going to go through our second session today, during which we're going to talk about ways in which the SEC can actually advance the ball and its mission with regulating crypto trading, with whatever that takes shape in. I'm encouraged by the conversation we had during the first session. I feel like it was lively, spirited. We covered a lot of ground, and it's the first step that the SEC can take in terms of listening to the industry related to crypto trading. Before we get actually to the panel discussion, I'd like to add another personal anecdote. I feel like if I'm up here, I have to at least do something and say a little bit. And I'm actually going to give a nod to Commissioner Purr. She had a speech a couple months ago called Sheep in the Steep. And I don't think it had a crypto thread woven through it, or at least if you did, it went over my head. I didn't pick it up. But it was really about these lofty expectations and these bighorn sheep that were able to scale up this really, really steep mountain against all odds. And it made me think of a children's book that I've read to both of my kids called Sheep in the Jeep. And it's about these wacky sheep who are driving this Jeep. Anybody know it? Yeah? Okay. So Sheep in the Jeep tells this story of these wacky sheep, literally, who are in this rickety old Jeep, and they're really trying to get it up this hill. It's really steep, and they're pushing and pulling, and they finally get it to the top of the hill. They're high-fiving, and they're excited, and they're celebrating, but they lose focus, and the Jeep ends up rolling down the hill, and it gets stuck in a puddle of mud. They're like, oh, shoot, what do we do now? So they're struggling to get the Jeep out of the mud. They're pushing, they're pulling, and it's not until some friends come over to help them that they're actually able to get the Jeep out of the mud. They're high-fiving again. They're celebrating. It's basically like that scene out of Zoolander with the orange mocha frappuccinos. You know the one? The sheep behind the wheel isn't paying attention. He's looking back, high-fiving his buddies, and they crash into a tree. And as the book says, the Jeep goes thud. So sadly, that reminds me of crypto. Lots of highs, lots of lows. And as we go through this conversation, which is going to be a multi-year conversation, by the way, I think it's important to not only celebrate the highs, but remember the lows and always continue to look forward so we don't go thud into a Jeep. With that, let's get started. We're going to start down the opposite end of the table this time. So, John, you're up first. And what I'd love to hear from everybody is, if given one wish, if you could wave a magic wand and get one wish regarding a change that the SEC could make or some step the SEC could take with respect to regulating crypto, what would that be?
It would be, as we go through these series of roundtables, to the degree I used this word a couple of times in the first session, as much precision as possible about what it is the problem is that we want to solve, rather than here's this interesting solution, what are some problems it could solve. I think that helps lead to, and these will be things we'll talk about later, the durability of changes is really, really important. And I think durability of changes and how they impact, whether it involves securities and tokenization, or it's just about assets that are considered crypto, that durability is what will, stand the test of time. But obviously, to the degree we can make changes along the way incrementally, I think that's a positive. So precision would be my ask.
I didn't hear a change that you wanted to make happen.
I have incremental ones if you'd like to hear.
Yeah, give me one.
Okay. I do think, and this is also something I said in the beginning, I think where entities that are currently regulated by the SEC, so this could include broker-dealers, it could include custodians, it could include clearinghouses, it could include ATSs, could include exchanges, where there are use cases that make sense from a practitioner perspective, as well as from an agency and service provider perspective, to allow, I think the appropriate types of crypto assets, which probably are more in the commodity token space, to be included in the BD construct, to make the create redeem process more efficient from a capital perspective and from an issuer perspective in terms of how they look at the AP-LP relationship. Oftentimes it's the same firm, but they have to work, they kind of have to go at it on the fly to figure out how to approach the LP space because it's an unregulated entity that they're having go out and get the Bitcoin and deliver it to the custodian. And then just from the custodian or clearing perspective, where products exist that are linked to the price or there's a NAV on the price of that underlying asset, there can be tremendous collateral efficiencies that come from it. So I think little things like that, while they don't seem like really big ideas, they can help unlock potential that, I don't think any of us on the panel quite know what that potential could be, but I do think those are areas that, I certainly hear from market participants would be welcomed.
Yeah, and I think for me and for Cumberland, as a market participant, I think just clarity on sort of the scope. And I think the first question that we talked about what's within the SEC's jurisdiction, what's within the CFTC's. I know folks on the panel have, I agree with what everyone said about, sort of the confusion and the, sort of investor harm, market participant harm, inefficiencies that come with, having to spend so much time sort of trying to figure that out. And hopefully eventually we have legislation that sort of puts in place a clear dividing line. But in the meantime, I just think, right now sort of, the courts were sort of coming to different conclusions, and there's sort of just a lot of question out there. And I think if the SEC could have guidance or rulemaking, while we wait for legislation that, for example, clarifies circumstances in which secondary market transactions would or wouldn't be viewed as falling within their jurisdiction versus being commodities under the CFTC's jurisdiction. I think that would be really helpful. Even just specific scenarios, like I mentioned earlier, of, for example, if there's no pooling of an investor's assets with the issuer for network development with the SEC, or what its staff say, maybe that's not an investment contract. I think just specific examples and sort of, rather than kind of just a long list of questions or, I think that would be really helpful just while we wait for legislation. I think it could be helpful.
Richard, you're up.
So my wish is that we get to a place where there's a regulatory framework such that we can deploy blockchain throughout capital markets. I believe it's a better technology for what we're trying to do. With blockchain, you have a complete record of securities ownership and transaction history, and it's designed for transfer of value. So much of the things that we do in equities, fixed income, and so forth today. And the way that we get there, or the way we start to get there, is let's use the blockchain as the official record of ownership for securities. Let's use smart contracts for settlement. And let's use stable coins or tokenized treasuries for the cash leg of security settlements as well. There's three.
So it's like there's a genie, right? If there's 3 wishes, we all get 3 wishes.
I'll give you 3. If you're willing to share 3, I'll give you 3.
I feel like my fundamental wish has probably already come through, which is that I certainly hope we don't, or by we, not we, the commission does not deliberately or accidentally undermine the benefits and the future potential of decentralized finance technology by requiring it to act or look just like CeFi. So maybe the additional wish on top of that is for the SEC to be a champion for the importance of peer-to-peer transactions, self-custody technology, and the value of the privacy and the safety to everyday people that can come from that type of technology. Because I think that embracing that technology and where it can take us does a lot to check against the level of trust that right now investors, everyday people, are required or necessarily have to place in third parties, in the traditional intermediaries in any financial market.
So I'll try. I have a few sort of broad things. I mentioned this at the beginning, sort of, the idea that we should really look at this next opportunity through first principles again and really re-examine which things do we really need and which things do we really not need, and make sure we're not bringing along with us into this new world of digital assets and blockchain and all the things that Richard, correctly said are possible encumbrances that actually will hold it back or not make it as good as it potentially can be. The specific things I would say are really helping refine what started as the special purpose broker-dealer regime and making clearer the rules around custody within a broker-dealer framework that would allow us to to bring an ATS into scope and begin to really experiment. And I think along with that will come exemptive relief around order protection rule and some of those things that will be required in order to make that framework work. And also a recognition that, and I think Austin made a really good point on the sort of global sense, and we've talked about it before, that these are a recognition somehow in that framework that commodities and securities need to not just live side by side, but integrate in a way that, I think when we use the word side by side, it actually doesn't do justice to, I think, what we're asking for, which is a completely holistic and integrated market structure that allows them to trade, allows them to be transacted. And also, I think importantly, which we haven't really talked a lot about, is recognizing that there's a broad universe of potential token types, including those that have consumptive use, and they need to live side by side in wallets and other things so that people can use them day to day in their activities. And so when we have the conversation about securities and commodities, it sort of leads us to believe that there are these very clear swim lanes, but in actual fact, it's nowhere near going to be that that clean and precise, I would say.
The thing that I would wish for would be that the capital formation role of markets be part of the conversation. One thing that we want is we want a way for people to come up with incredibly clever new things that require tokens as a means of getting those things to work as business models and be able to essentially sell them on exchanges in a way that makes consumers comfortable and the markets are liquid and basically the economy grows. And so I think it's really, really important when thinking about the market layer just to recognize the reason why we have markets is so people who are innovating can actually get funding from people who want to put this in their portfolio and grow the economy with it. And so that would be my wish.
Great, yeah, and agree with a lot of the things that have been set up here. One thing that I would add that the acting chairman touched on at the beginning too, is also, a lot of my points have been around like U.S. competitiveness globally and the opportunity for us to build the leading market, both in crypto and I would say digital asset securities too. I think one of the challenges that I see within that is this patchwork of regulation that we have across so many different regulators today, right? If you are a company that's operating similar to a FalconX or a Coinbase and operating either on the institutional or retail side of the market, you can easily end up in a scenario where you have over 50 regulators, right? Including all of the states and CFTC, SEC. And if you want to be a global firm, which I do not believe you can be in this asset class and operate at scale without also operating global businesses here, you need to, obviously be registered in those different regions. And so I think to the extent the SEC can work in consolidating and some sort of federal preemption in these different areas, I think custody is an interesting area to look at. I also think to the extent there's an opportunity to look at that for trading, that would be a big unlock for firms here to be competitive, not just in the US, but also at a much more global scale.
So if I was thinking of one small thing that could change, I would just say merge the SEC and the CFTC. Just a little ask. And then dramatically increase funding and technology and teams of quants and such. So I assume those are easy things to do and can be done pretty quickly. But if I'm thinking of harder things, maybe something as simple as saying that tokenized shares that are fungible with registered securities shouldn't require separate registrations or disclosures if they're trading on a registered exchange. So I know we're talking about sort of ATS versus exchange, and I'm going to come down on the side of I'd rather see things on a national securities exchange. I'm going to say I think there's good arguments either way on the issue, but I'm going to come down on the National Securities Exchange, and I'm going to equate it to something like, we have options contracts that don't require this, kind of crazy separate registration process or anything. There's a short form registration process for like an ADR. These things all seem very equivalent to me to tokenized securities. And I think if we look at where the U.S. could really lead right now and where the SEC has a central role, it would be in this space of tokenized securities, where we have the largest securities market in the world and the opportunity to allow our existing regulatory framework to expand and encompass a new class of securities, or maybe not. Maybe they're not securities if they're tokenized securities. But there's enough crossover and fungibility that there's a lot I find appealing to maintaining this model, and then to sort of build on what has just been said by a couple of the other panelists, that you need to extend that to down the line so that brokers can again custody and manage both traditional securities and crypto asset securities and tokenized securities. And I think that fits really nicely into our current regulatory framework, and doesn't require a lot to enable. And I think that there are exchanges or ATSs that could really thrive in that, with that approach. And then we can kind of grow from there and try and figure out the more thorny issues of how do we really get this deep cooperation between regulatory agencies? How do we get this deep cooperation between global regulatory authorities? Which I really struggle to see a way that the world can approach this industry without, way more cooperation and intertwining of resources than we've ever proven, able to before.
Thanks, everyone. Greg, did you want to go?
Can I just want to add one thing, which is, when I'm advocating for a broker-dealer and an ATS model, that's not to the exclusion of an exchange model. And I think what ATS showed us was that it wasn't just competition among participants, but competition among business models that actually got us to the best possible place. And so I didn't want to leave the impression it's to the exclusion of, but rather in addition to.
John, yeah, go ahead.
One thing to Greg's point that I think is critical, absent the label you want to put on a venue where people transact, right? ATS has evolved, again, for different reasons at a particular point in time, and there's a structure that exists now that is, allows for more flexibility than what national securities exchanges are required to do. I think the critical piece with this is again, understanding the use cases. I think there's certainly a number of interesting areas where tokenization of some security obviously makes a lot of sense in terms of more efficient collateral management from a clearing and settlement purpose. On the trading side, I think it's interesting. The use cases I've heard that resonate the most are kind of on the margins, right? That doesn't mean it's not something to explore, but the key is to not bifurcate the current share class structure and, think of something like a corporate action like a dividend. A dividend fundamentally flows through from the issuer, is given to the DTCC, goes through a transfer agent to make sure that all shareholders of record get that payment, right? And I think we have to be mindful of unnecessary fragmentation of, there's a similar share class that was somehow separated by someone trying to carve it out and leave it in a wallet somewhere like that. That's not a good thing, right? That's not something that's in the public interest. For what reason are we allowing that to happen? So I think where things aren't broken today, we have to be careful not to let the vertical integration part of the legacy crypto world, which I think is probably a function of, as I said before, the lack of regulatory structure that was willing to welcome them in, to not, create excessive issues such as the dividend example. So I think it's important.
Christine, I know you're short on time. Is there anything you wanted to jump in with generally, any area?
Sort of awkward, but no.
Sorry, okay. Okay, I just wanted to give you a chance, yeah. That's okay. Let's talk about trading of assets that might start out as an investment contract and therefore a security. And let's just say for it's Friday, we want to think optimistically. Let's just say there's some guidance from Christine, thank you. There's some guidance from the commission or the staff that, what is maybe an investment contract to begin and later just simply an orange doesn't need to go through an SEC registered broker or exchange. Thoughts? Round robin, anybody can jump in.
Well,
Richard, do you want that?
I think that what I heard there was that it starts in an investment contract and changes. I mean, if it's an investment contract, it should probably still be offered in the same way, whether it's Reg D, Reg A, or registration.
At the outset, you're suggesting?
At the outset,
Yes.
yes. I think what there's been some discussion on over the years is, how does it evolve? What does that process look like? There's a term sufficiently decentralized. I don't know if that matters anymore, if that's a thing that people are looking at. But at the same time, we've had, tokens that are sold in a securities contract with the knowledge that the tokens aren't the securities. So I don't really have an answer for you. I just had they were just my comments on that.
Mm-hmm. By a show of hands, do we want and need that guidance? I mean, raise it proud if you're going to raise it. Yes, okay. Okay.
I'm
Yeah.
raising that we would want the guidance that this is the case, correct?
Yes.
Okay, just making
Yeah.
sure.
Yes.
We don't want no guidance. Yeah.
I mean,
Yeah, I think
for each of your business models, is it important to get that? I think the answer is probably yes for most.
Yeah, I think, look, to talk from more of a markets perspective in terms of what we've seen within the space of the previous years, or the previous year and a half really at this point, I think the great thing about blockchain and tokens is that they're open, freely transferable. And within that, they can enable a lot of both financial and non-financial use cases that otherwise would have been impossible. I think at the same time, I think some of the challenges can be identifying, and especially for investors at the initial stage, the actual quality of the investment that they're making, if they're making that for investment purposes. And if I look at that from an institutional market perspective, right, we don't service retail directly. FalconX deals with a number of institutions from asset managers, venture capital firms, hedge funds, et cetera. And many are playing at the earlier stage side of that market where they may be looking to seed net new layer ones as an example, or distributed file sharing applications or whatever that is. I do think that when I talk to customers, they would value some sort of framework for those initial issuances. So there's at least standards and disclosures of what that is. Then I think the question is at what point, and we've been discussing this for years, those applications then become sufficiently decentralized. I think to the extent that happens, it will be very powerful for the space, not just from an investment perspective, but I'd say from a broader adoption perspective too. I think the interesting thing that I've seen over the previous couple of years, or really the last year or so, as we've started to move more towards regulatory clarity here, is I think you have a lot of people, both entrepreneurs and established companies, who have been in the sidelines from this space and have actually not necessarily we have great talent within this space, but I don't think that we're operating at 100% in terms of the net new talent that we're attracting or the companies that we're investing within this market. And I think that the benefit of regulatory clarity there is I would expect you would see large US technology companies move into this space. I would expect you would see more Web 2 entrepreneurs moved into this space because they'll have more certainty in terms of what they're able to do and the corresponding risks that they're taking. So I think that there's a lot of benefits to that being the case that would create a much better and more robust market itself.
Some of these, Nick, strike me as maybe the things that we're hoping for from congressional action in the bill that's making its way through, in addition to the taxonomy from a capital raising perspective, when something transitions from one thing to another and those sorts of things. So, my sense is we'll have that sooner than later. But since we're asking for things, that'll be a fourth thing, if we can ask for that. But that, I think, is where that will come from as opposed to, guidance at the agency level.
Okay, Chelsea?
I was just going to say, I think, to Austin's point of, wanting sort of disclosures at the outset where, maybe a network hasn't become sufficiently decentralized, you're sort of in the initial sale where you think, maybe this is an investment contract, like theoretically it should be registered, but we've all seen, sort of the issues with typical, Securities Act registration for a lot of these tokens. I think, Commissioner Peirce's proposed, Rule 195, I think, that set of disclosures, I think, at least we think, is sort of a very reasonable place to start of, making sure that information is out there and that, people like, Austin's customers, other market participants can have the information that they need to be informed. And then, but I think it also sort of gives a good set of, criteria for when, a network has become sufficiently decentralized. There are, people other than sort of the initial project team who are, working on the network, developing it, able to, maybe operate applications on it and able to participate in governance so that it's, there are sort of metrics that I think are helpful and sort of having this sort of exit report idea of like, okay, now we know that it's either become sufficiently decentralized and there's sort of this marker of, so okay, then it doesn't need to be registered, or, it does need to be registered and sort of here's the process that you go through. So I think that kind of, until, like Greg said, until there is legislation, if, something like that were done in the interim, I mean, maybe legislation happens as quickly as we all hope and we don't need it, but, sort of, we'll see, but.
Go ahead, Dave, yeah.
Yeah, I'll admit that this is like a question I really struggle with because, it's almost like saying when, in the traditional finance world, you have the primary offering and then you have secondary trading. And it's always been sort of this clear connection that what you're trading is a security because, for all the various reasons that it satisfies, these legal tests. And then we get into this space and it's like, yes, okay, so there was a security offering. Let's say there was. That was the primary offering. And now you're into secondary trading and there can come a point where it's not a security. And I think without that kind of clarity, I don't understand how you can have something trade on the secondary market. It's almost like this is a great example of where our current structures from the traditional finance world really start to break down because they didn't, I don't think, conceive of this particular scenario, and yet this is like so common in crypto. And I think it's really hard for those of us who are so used to the world of equities, of secondary trading, to say, no, it's something fundamentally changes about it as it moves from primary to secondary. That's still, like, I really struggle with making sense of that. And so I do think if there was this clear set of criteria to determine that something exited, yeah, that would make perfect sense. But without that, to me, it still really feels like a security that's in the secondary market that you're, expecting to go up in value because of the success of this venture, even if it's maybe decentralized, so it's not a common enterprise. And, this is why, like, I don't know, I really struggle with this question, and I don't know if that's helpful at all, but, maybe once we get to that point, it would make a lot more sense.
I think that the reason you struggle with it is because the use of investment contract as the security catch-all to try to capture crypto trading is not fit for purpose. And it may be fit for purpose for a primary offering, but it's not fit for purpose for a secondary offering, whereas stock and equities, those are defined categories of security. So you do not have to fit it into the concept of an investment contract. If you did, we would probably have that same problem, right? So I do think it's important to get more guidance, whether that is from the SEC or through legislation, on primary offerings and secondary transactions of assets, of digital assets. I think that is still something where more crispness about how we're going to categorize things, however we end up choosing to do that, would prevent us from getting in this quagmire of, well, let's pull this language and stretch it in this direction a little beyond where it could possibly be stretched.
It's kind of, this is a good question, Nick, because it's kind of one that's got us all sitting here, we're all kind of thinking. And, this is, again, just off the top of my head here, like, part of the narrative over the last few years was like, how do we avoid being a security? We don't want to be a security. But maybe it should be more about, it doesn't matter as long as there's a registration process maybe it doesn't matter as much. Like, to take Reg A for an example, is there a way we could use that? And, it's an easy way. There's disclosures. We understand it. It's available to retail. There's secondary trading. There's some SEC qualification. And it doesn't really matter too much if it's a security down the line. And maybe that's just an idea I'm putting out.
John, were you going to say something too?
I was actually going to agree with Dave that it's hard for me to wrap my head around it. I think what Catherine and Richard said helped. I think it's interesting to me to think about, are we talking about private enterprises that want to use use aspects of this technology, like Christine talked about capital formation, right? And so one area where smart contracts and technology in this area could be interesting is allowing an issuer and an individual investor, or even a pool of investors, to access private companies earlier, right? And that's important because it's one area where the technology's evolved in a lot of ways. There's a much higher degree of fidelity of control there to give the issuer a bit more control and things like a vesting period where they might need to feel comfortable, giving more robust financial disclosures, transparency around who the ownership and where it's transferred to. And those types of things could lead in a very healthy way to more retail participation in IPOs. Like, that's a really good thing. I don't get how that could not become a security though. But I think, that's something that hopefully we'll get clarity from out of the first panel, the first roundtable.
Yeah, I think one thing that I'd chime in on, because I think that this is like a fundamental challenge in a space that's so heavily driven by like decentralized applications, is like it's just branded really poorly overall, right? Like, even if you think about the term cryptocurrency, everyone talks about like cryptocurrency asset class. It's like, how many of the top 100 tokens are trying to be money or currency? Like Bitcoin and a few stable coins, right? And I think the reason these conversations, I agree with you, they become complex, and I think they break like the traditional framework and thinking, is like, in many ways, you're actually just looking at running the next version of the internet over some application, right? And so the way I would think through it, and the way I've like got my head around it, is like, okay, if I think about like a decentralized file storage network as an example, how does that run on a securities exchange, right? Like, it just logically does not make sense, right? And I think that you have similar, like with an L1, like an L1 is just like a new version of computing, right? And so if that's going to sit on a securities exchange, like, I think that the fundamental use cases actually then don't work. And so I think that's the challenge. And on the other side, you definitely have financial applications that should be securities, right? Tokenized money market funds, treasuries. I don't think anyone has an argument that those are not securities in the ways that they're acted. But I think the question is basically, okay, what are these different applications endeavoring to be, and whether those are financial or realistically just internet and technology applications, and then how do you actually ensure the highest probability of success for those?
Go ahead, Dave. Yeah.
So just a small ask again, like, we just need this comprehensive taxonomy of crypto assets with clear regulatory assignments, right? And then everything would be solved. But I think like those are great points. And also, like what you're saying, John, and what Christine said earlier, if this helps us provide more opportunities at earlier stages to individual investors, that can be an incredibly good thing. What we have seen in the regulated space is that the opportunities for individual investors have declined dramatically as fewer companies go public, and the ones that do are much bigger. And people don't get to participate in that wealth creation process like they used to, and that's really a problem. And this is an area where I really like the idea of using Reg A, or Irvin. We funded ourselves with Reg CF, and it was a very reasonable process. And we have 2,200 retail investors in our company, and we're registered with the SEC. And it all worked out really well. And I get what you're saying, Austin, about the distributed file store on an exchange makes no sense. But there are level one protocols where I think you could easily imagine that the token or the representation of that can trade on a registered securities exchange, but not the application of it, right? You can be running a staking node, for example, or a proof of work node, whatever it is, a miner, and generating these tokens, but then have a place where you have all of the standard protections that you would expect from the registered world, and you can take it there, and now suddenly you have a much larger market and a much broader participant base if you want to sell your tokens. And I don't know that is where we're going to get to, because I don't know that like L1 tokens are securities in most situations. But I do think there's sort of a delineation there between trading something versus the core operations of a network, let's say.
Okay, Greg. Yeah.
Just one slightly bigger picture point I wanted to make is that among all the things we've talked about, the real promise of this happens as we move closer and closer to DeFi and closer to decentralization. And the point about the benefits to the consumer extend to things like participating in governance, participating in the ability to be part of the proxy process, to be part of a lot of things. And there's going to be a period that's going to take a long time before we have things that look like centralized exchanges that are happening in DeFi and those kinds of things. But that's the direction of travel, and that's the thing I think that will make the surveillance easier. It will make a whole lot of things a lot better. We're going to live in a world for a good period of time where what's happening in the broker-dealer world and in the ATS and exchange world and surveillance will be complicated, but I think we also do have to start with the end in mind here as well, which is what we want to get to should be much easier, and it should be on-chain, and it should be easier for retail and others to be in control of their key material and to be able to participate in capital formation, whether it's through capital raises or in the voting process and a handful of other things. I think starting with that vision in mind, I think, is critically important.
I guess I also just wanted to add to the conversation, since, Richard, I think you raised a fair point. Well, are we at a point where we could more comfortably categorize more assets as securities? But I do think the answer is no. The reason we categorize certain assets, well, a reason that we categorize certain assets as securities is that there's often a significant information asymmetry, and they are meant to be an investment that comes with promises from a third party that you have to rely on. That is a narrow category of things, and not all investments at all, if we're talking about investors, not all investments at all meet that. And certainly this maybe goes to what Austin was explaining about, different types of tokens or assets or blockchains. Not all of that in any way could be mapped onto what a traditional consideration of a security might be. And I don't think it should, because then we may prevent the invention and use of digital things that are very important to our future, that maybe someone will use as an investment, but have very important other uses, and we do not want to stifle what those future uses are.
Can we sit on capital formation for a minute? The driving question I have is, why haven't we seen more tokenized offerings, like real regular Reg D offerings, Reg A+? Is there an impediment or other blockage that is an SEC issue that they can maybe seek to fix? Is it, what's the answer there?
I think we might go back to my wish list for that one. I think there are some limitations that we've had to work around. The blockchain is not allowed to be the official record of ownership, generally speaking. So there's been a transfer agent has been required to maintain off-chain books and records. So then you're not really able to take advantage of a lot of the benefits of blockchain. If you've got this kind of, if you look at nearly every tokenized money market fund filing, they use the words, oh, and by the way, there's an ancillary blockchain record. They have to call it an ancillary blockchain record. And then when it comes to we want to bring about a lot of the benefits of instant settlement and transparency and so forth. And then there's a problem when you get to use smart contracts. So what a smart contract can do is, and it happens all the time in DeFi, is you put one asset in that's the buyer asset and another asset that's being sold. And if there's a match, if the price is right, then they automatically settle, going to the counterparties there. In traditional securities world, there's a big question of possession and control. Like, who is in control of that asset? And it can't be. Generally speaking, it has scared regulators that the idea that a computer code could be in control of the asset, especially when you have, frankly, a lot of very negative headlines around hacking and so forth, and risks around that. So I think if we could move forward on those two areas, then I think we'd be able to really start realizing a lot of the benefits that we want, companies like my company want to bring to traditional capital markets. But we really have to lean into the technology and use some of this kind of innate functions and features that they have to do that.
I'd like to add to that because I think Richard hit on a really key point, because one of the key benefits to blockchain technology is this idea of the efficiencies and transparency you can have into the clearing and settlement process. And I know that's another roundtable, but I'm just going to dip into it for a second because it's something that I hear a lot of, that we have a very opaque system today in equities. And there is this vision of a completely transparent future where everything settles on chain and all records are visible and traceable, and if not instantaneous, near instantaneous. And I think that's a very laudable goal. Like, I think that is a place that we can get to, that you can introduce true efficiencies into the traditional finance world, let alone enable a whole new space in the tokenized securities world. So it seems like a really smart change to make.
Yeah, I think a couple thoughts on the initial issuance side. One is, I think we touched on it in terms of like the process from going to initial issuance, like security, to like commodity at some point. I think to the extent there is clarity there, I think more launches will happen in the US. I think that happens, just not here. And so I think that's one component. But I think that that's actually more on the decentralized network side of the space. My second point, which is my personal opinion, is that I think for like private company capital raising and formation, I think there can often be a negative selection bias in terms of the assets that basically get listed. Because if I think about us, we're a venture-backed company backed by like Excel, Lightspeed, Fidelity, GIC, and others. Like, that's the capital that's most attractive for us to take for a number of different reasons, versus basically going public early without the benefits of being a public company, right? And having this liquid security that's ultimately trading. So I think that's a challenge. I don't know the solution to that, and I don't necessarily know if that actually is a problem that needs to be solved. The last thing that I would mention is I think, I think on the like global side and like looking at tokenization, I mean, my perspective is that the largest demonstration of tokenization that we've seen to date has been the tokenization of fiat currency on chain with stablecoins, right? And I think it's often not talked about in the context of tokenization for whatever reason. But I think if you look at the use case that's actually being tapped in there, and we service customers in a lot of or B2B2C, wealth or investment platforms, payment companies in different emerging markets, the use case is people in those markets holding US dollars, right? And the benefit that they're getting through tokenization is basically exporting a US financial product, in that demonstration, a dollar, for someone to basically hold. And I think that that's actually the most interesting use case that I've seen of tokenization, right? Is like, yes, there will be efficiencies in trading. I think like tokenizing US equity markets, to me personally, is less interesting. But I think if we're looking at like tokenized money market funds, treasuries, different instruments like that can get broad, wide-scale adoption outside of the United States and actually give the US capital markets a completely different lens to what they're able to tap into, I think that is actually super interesting.
I think one area where that, I think, scales is when you think of it as a use case for more efficient collateral management. And that there's a benefit there, and we may talk about this later, but I wanted to make this point at the end of the first session. I think another thing that people kind of, I think, connect naturally to the idea of a stable coin is its usage for, on-chain settlement, or otherwise known as atomic settlement. And I think, Chelsea had brought up at the end, there are sometimes there are time differences between when one counterparty might settle versus another. And one thing that I think is often overlooked with, very mature markets, like say US equities and others that have a fixed settlement cycle, is I think it's really important not to discount all that goes into the centralized clearing process, right? You have netting, you have obviously collateral efficiency, you have a very complex world of liquidity provision that, risk is nonlinear, right? So if I hold the position in one thing, I'm not offsetting it when I sell it, right? And a lot of that is driven by, balance sheet, lending, things that go into that clearing process kind of can create a different outcome than a pre-funded trade. So the example I like to use is if you have any stock, you might have the pre-funded price, and then you might have the T+1 price. And you might logically think the T+1 price is going to be the time value of that money. But what if it isn't, right? And it may not be, because there are other things that make that T+1 price a little bit more efficient. And so I think as we think of stable coins and atomic settlement, it's important to kind of understand almost settlement as maybe a spectrum rather than a either or, right? So I think that's a key point.
Greg, I'm going to put you on the spot. We've talked a little bit about Reg ATS and that maybe being a model
Yes.
for crypto activity, crypto trading. Under Reg ATS, there are some, I'll call them carve-outs or exemptions for certain activity that is under a certain threshold, and you don't need to do some of the stuff in Rule 301. Do you think that could serve as a good model for even new entrants if we're trying to promote competition, say a de minimis threshold under which, like the capacity and integrity part of Rule 301, where they might not actually need to either apply for a certain status or comply with certain SEC requirements?
I do. I think that, I think if I look at the market structure today, that the best way to come into something that looks like the overall national market system today is the ATS framework. I think that if I think back to the origin of ATS and the benefits that had, it encouraged people to participate in that. It was a framework that more easily allowed for the creation, and then over time it evolved to be more stringent, and you learned as it went, and we now have sort of the next iteration of ATS. Mm-hmm. But I think it was the right thing at the right time, and it feels to me like that is exactly the sort of thing that, or something like it, that's required for crypto and digital assets now.
Go ahead, John.
One thing just to follow up on that, to take a slightly different vantage point on it. I think the original Reg ATS kind of brought forth the ECN competition to the existing national securities exchanges, and I think they operated very much like exchanges, right? Anonymous limit order books with some disclosure. They had quotes. There was no market structure framework to make them a part of the national NBBO. Many of them would quote NASDAQ listed names pre-NMS through NASDAQ systems, but post NMS, all of those ATSs became exchanges. And then what happened, right? There was this structure laying around, and a bunch of smart people said, oh, we can use this internally to pair off internal interest, right, to save on execution costs. The cleverness of the broader marketplace, and I mean that in a good way, right? I think we have brilliant people that work in all of these industries that when you let them think about either working with the rules of the road as they exist, or help create new rules of the road, interesting things happen. But the follow-on to ATSN and other parts of it really were, I think, a response to how this thing was used in a different way once you shut the quote off. So I think it's an interesting example of the law of unintended consequences, and who knows what the right structure is. I think it depends on what it is, again, precisely we want to accomplish and we want to do.
I would argue we're closer to the start of when sort of ATS was invented, and this is sort of a nascent and formative asset class that needs a slightly more plastic environment to grow up in, if you will. And then at some point, it may turn out exactly that way. But I think at the moment, the more flexible it is, so that we can learn and adapt, I think the better. I think the moment we put the rigid, Form 1 sort of structure on a very nascent asset class, I think we will not see the kind of evolution and competition, all the benefits that we had out of that I think we can get.
I think you both make good points. And it makes me think of some of the existing market structure struggles that we continue to have. I mean, Dave, you mentioned earlier that you wanted to bring crypto trading on exchanges. We can't even bring equity trading on exchanges. But execution quality is fantastic. You've got, I think it is, 50 or 60 NMS ATSs. Almost as many exchanges at this point. And it's a very fragmented market structure. And then, of course, you've got the market makers who are doing, not without ATSs, are just internalizing orders. But it kind of works. I don't really have an answer here. I'm just saying, there's not a perfect world in either scenario, but certainly the ATS model has worked. And when you look at the end result, it's generally been good for investors.
Yeah, and I raised it because the goal of this second session is to ideally give the commission and the staff some ideas that they can run with. And I know almost everyone has submitted a comment letter, or, ideas or responses to the request for information. When I think about ATS, two things come to mind. One is we have this known model. For better or worse, though, that known model requires that as a prereq to becoming an ATS, you must become a registered broker-dealer and FINRA member. Anybody have any thoughts about that? Is that something we would be comfortable perpetuating, or is that something that we think would actually be perhaps detrimental to the path forward?
Well, I do want to just, to Richard's point, I think it's such a huge problem that more equity trading is not on exchange, and from an execution quality, but really from a market quality perspective, I think it has led to wider spreads, and in fact, the levels of internalization we have in the equities market leads to 25% wider spreads than we otherwise would have. And I know we're not here to talk equities, but it's hugely problematic, which is why maybe I lean more towards getting trading on exchange in crypto where possible, because I think that the transparency and the price discovery process works fundamentally better on exchange, or almost at all. But maybe that's not a great analogy to crypto, and so maybe that's sort of like my biases coming out. But I do think when you think about using ATS, I think one of the things I said earlier was we could expand the definition of special purpose broker-dealer, and that is a nice pathway towards being able to trade and custody both crypto assets and traditional securities, and that seems like a good pathway towards potentially being able to leverage ATS. As Greg said, alongside national securities exchanges, which should have a role in this, and I do think there is a lot of interest out there that I see, and I advise one company that they want to be a national securities exchange and trading tokenized securities, and they have very novel and innovative thoughts and model on that, on how they can develop that sort of book, the digital book alongside the traditional book, and bridge things back and forth. And to me, that kind of innovation in the exchange space is very exciting, potentially maybe more so than in the ATS space, but I definitely see the argument for having both of these as options, for sure.
Seems like you ignored my question. Do we need
I said special purpose broker-dealer.
do we need FINRA in the mix for whatever this crypto trading activity is that may or may not be through an ATS-like regime? Should that be a
It's a
prereq?
pretty fair question.
Well, if we're saying that we want broker-dealers to trade, to facilitate trading of crypto for investors, then FINRA is our SRO. That's how it is. I mean, I don't know if you want to go down the road of shaking all that up as well.
I mean, I asked the question.
Yeah.
I think I do.
I tell you what, I don't think we need. We don't need a new, separate, different SRO. That'd be a terrible idea.
I mean, we have the SEC.
Merge
Yes,
the SEC, CFTC, and FINRA. Then is that what?
That's right. Yeah.
Okay.
So maybe we merge FINRA and the SEC and the CFTC. There we go. We got it, right? We're done here?
It strikes me that there probably isn't a way in which you could say we're, given the structure that, we've proposed, where the brokerage function of being custodially in charge of clients' assets is merged together with the matching of buying and selling, that there isn't a way to do that without that first part being a broker-dealer, because you are holding customers' assets, and that feels like an important first principle. I don't know that there's a way, unless you're totally just saying, in a DeFi-like capacity, you're a platform in your technology and it's self-custodial. There, I think it's completely different. And it's not a broker-dealer, and I think it's peer-to-peer and so forth. But if we're custodially in charge of holding clients' assets, I think that's a broker-dealer.
Catherine, any thoughts?
I agree, you're not a broker-dealer if you're not custodying assets. Was that the question?
Something like that. Yeah. Any other thoughts?
I guess to take it a step back, I was pondering the debate about an exchange or an ATS, but reminded of one of the starting points, which is that we're talking about crypto securities trading, and that is still a very narrow set of the broader category of crypto trading and all of the types of digital assets that there are. And we've identified throughout our discussion today the need for lack of a better term, side-by-side trading. I'm not sure what the right terminology that we've settled on is. But does the rigidity of an exchange model fit more in a universe in which the vast majority of assets or transactions would be viewed as securities, which I don't think is the case for crypto trading generally. So the last half of that hypothesizing is more my view, but the first is truly an open question. If we're thinking about the right structure for crypto securities trading, how does it solve for the other questions that we've raised of side-by-side across asset classes, trading a global regulatory regime where there isn't necessarily the same type of securities or commodities distinctions, and 24/7 trading and trading that will happen, crypto trading that will happen elsewhere in other parts of the world, regardless of how we structure it. So how does that fit into our choices of structure?
Yeah, well, as you mentioned, 24/7 trading, and Austin, you've mentioned the global nature of trading in this space. And, John, you work at a global SRO operator, right? Exchange operator. How should the SEC be looking at its role, recognizing that trading is essentially 24/7 in this space, that there are regulators, even in our own country, who have a head start on the SEC, one right across town. There are many states that are already ahead of the SEC in terms of their thinking and what they've been doing, and certainly global regulators. So how does that affect your view on these issues and how it should influence the SECs at the same time?
I mean, I think it's unquestionable that the demand is there. I think to me, this is just an interesting question too. You take the world of NMS securities, right? There's many of them. Now, if you look at even the existing 16 hours, 5 days a week that the equities market trades, You have some ATSs that kind of fill in that 8-hour gap. The breadth of names obviously is a lot less than you have during the regular session. But even then, they're not, to use your oranges analogy before, I think we're sort of comparing apples and oranges in that, the market that, likely comes to mind for most people when they think about 24/7 trading of crypto is Bitcoin, Ethereum, right? The most liquid and largest of the crypto assets. And a lot of that is just driven by the ability to settle it, again, atomically on chain. And, I think that's an open question, right? Like where that fits in, how that fits in, what's the use case for that, and why, what's the problem people want to solve with it, I think is a good one. Perhaps that's one, right? Trading on weekends, if that's ever a thing. I think outside of crypto, though, right, and the most liquid crypto assets, there aren't a lot of markets that trade, on weekends and holidays, and I think they're different, right? They're, as Austin pointed out before, right? Bitcoin is like it's a global thing, right? You have a U.S. company. How do you handle holiday? I mean, there's lots of nuance, and the assets themselves are different. So I think it's there. I mean, my view is it's likely to be in the 23.5 range, right? Looking more like futures, at some point next year, with all the plumbing in place to help drive it, which will be a good thing. But I think it'll be interesting to see how broad the participation is, because I think one of the things that makes equities what it is we welcome in the broadest possible base of participants, right? You have retail trading with retail on exchange. You have market makers trading with market makers, principally, the agency firms and institutions trading with each other. So I think the more vibrant that is, the better the market is.
So next month, we have a CFTC regulated DCM, an FCM that we are making 24/7, I think for the first time in the futures world. And there were no shortage of issues navigating, having other FCMs and other participants come along. But the support has been enormous from the entire community. And in the case of, to your point, Bitcoin and others, it is not a great experience on a Saturday or Sunday to be long a future. And so I know that's different than securities, but I think that we sort of navigated bringing sort of TradFi and all of the participants and systems and clearing and so forth along with, and it's we're quite excited about it. Thank you.
Yeah, to just chime in, a couple of different thoughts. I think one is in relation to just like what I think we're trying to solve within this space. I've heard Raghu, our CEO, like use the analogy of like, what if, why are we okay with like Google and Amazon, like, or if Google or Amazon didn't work on nights or weekends, like, would you ever use those applications, right? And I think the interesting thing is, like, if I think even recently, a few days ago, I was literally just trying to move money from a bank to a bank, and I would doing it after work, and I was like, okay, well, like, this is not a great customer experience. And I think a lot of that is, kind of what we're trying to solve with crypto and tokenization here. And so I think from my perspective, for tokenization to be successful, you need to be able to operate 24/7, 365. I don't really think that there's a path where tokenization will work, and that won't be the case. And I'm sure there's a lot of components. I mean, we've talked about from a SEC licensing structure today, broker-dealers, ATSs, exchanges, et cetera. And I think there's a lot of components underneath those, whether those are circuit breakers or otherwise, that just the market timing hours are going to be influenced, right? And then we need to dive deeper and really understand. And lastly, what I would say is, I think we've seen the benefits of this in our own business, just in our derivatives business itself too. We operate as a CFTC regulated swaps dealer entity. We have a large options business both in the US and globally. And you see a significant amount of activity that happens over weekends. I think especially this year, right? If you think about all the different big news events and macroeconomic shocks, that have happened over that time period. And I think the activity that you also see is people hedging their BTC ETF exposure through derivatives because they cannot get on and sell that asset, right? And so I think that it will create more efficient and effective markets over time. And I think there's already demonstrations of that working at a federally regulated level today.
The point Austin made me think, there's a difference between an individual company share and, a broad-based index, something like, an ETF like SPY or, even some of the levered ETFs that have evolved around these indices. And those are the types of products that, yes, technically they're securities. That's a different, in my mind, that's a different exercise. And it's an easier instrument. Like the less instruments you have, the easier it is to sort of coalesce liquidity around it. And so I think the thing with individual companies that I think time will tell is like as you go further out that curve, how vibrant is that market in terms of the participation level. And I think that's something that at least when we think about it from the issuer perspective, we want to try to make that as broad as possible.
Let's change gears for a sec. So one of the bright spots from the SEC's regulation of this area has been the approval of listing and trading of crypto ETPs, right? As some of those ETPs seek to get approval for, in-kind creates and redeems and maybe even staking, how do you see that affecting trading in the space? And, is there anything you can see that the SEC could do to make that more viable for the market?
We would very much support the allowing of in-kind creations and redemptions, and in fact, the plumbing for that was put in place very early on. And I think having both options for issuers and for APs and investors will make for lower costs, lower frictional costs, a better experience. And there really isn't any, in our estimation, good reason to not allow for the in-kind, the in-kind method. On the staking point, we're quite excited about the potential, and again, supporting our issuers. This is really them driving it and us supporting them from a custody perspective. And think there are ways just with staking as it is today, before we even get to the world of liquid staking tokens and all the things that will allow for an even more sort of fulsome getting to 100% of the fund staked in that world. But even before that, just with staking as it is, our research would suggest that a good proportion of a fund could be staked, leaving plenty of buffer for sort of redemptions as they've happened. And that's looking not just at crypto, but in the past at other similar assets in terms of redemption size relative to fund size, et cetera. And so we think upwards, our research would suggest upwards of 80+% of the assets could be staked and still provide the necessary liquidity in the case of a redemption. And we've provided that research both to our issuers and to regulators as well.
Okay.
Agree on the staking point. I think it's solvable is probably the easiest way to say it. Issuers are willing to work with the SEC to solve it, appreciating, this difference between Ethereum, Solana, and other protocols and how long, something has to be, put out there to basically be a part of the staking process. I think the create redeem one's a really good example of like, if the SEC can get comfortable with an AP handling Bitcoin or Ethereum to facilitate a create redeem, that might not be, this is something you should get broader feedback on. That might not be enough, right? You might find some firms that are very active, and I mentioned this before, that AP LP space is really important to understand, right? The AP is the authorized participant, it's able to facilitate the create redeem. The LPs are kind of oftentimes the same firm, right? One's in a BD, one's operating the LP trade in crypto markets out of an unregulated entity or an offshore entity. And I think without thinking about, okay, how can those firms bring that together, right? Bring it together in a way where things are more efficient from a collateral perspective. Things are more efficient in terms of how they structure those entities. Like, it's not just about the BD and the create redeem. I think you should think about the entire vertical of, or stack of SEC entities that are regulated and, again, understand what the objective is, and get sort of broad feedback about how would market participants actually utilize that? How would that improve outcomes for investors? And, the ETF thing, I think more broadly, it was a long road, right? And I think, I'm sure those of us that are here, and I'm sure the task force would agree, it would have been better in hindsight if that would have gotten approved faster. It's been a good thing for, I think, all of the counterparties involved, in the sense that you have this emerging asset like Bitcoin. I'll use that as an example. It had found its way into the world of the CFTC, and it had, vibrant futures markets, vibrant options on futures. It took some time to get into the ETF market, but I think looking back, that's yet another success story for the ETF as a wrapper for a variety of different assets that don't fit into the typical mold of what trades on a exchange. And I think we still have some ways to make that more efficient, right? You can have options on an ETF. You can't have a cash settled option on like a commodity based index. Like, there are some areas where we can do a better job of putting the patchwork together. I think those are some things that, to Austin's point earlier, do force meaningful trades that market participants want for real reasons offshore. And I think those are things that, we should all be mindful of. But, the ETF story is a good story. And I think the more clarity the commission can bring in terms of generic ETF listing standards, that's only going to help the industry move quicker.
Pretty darn close to the end of the day. Maybe I'll toss it up to a round robin. Everybody can kind of get a closing remark, and keep in mind we're in the session trying to offer up ways in which the commission can move the figurative ball forward. So Dave, maybe I'll start with you.
Yeah, first of all, just thank you to everyone. Really enjoyed this. I thought it was a great discussion. I hope it was helpful and interesting. I think that it seems to me like some themes really emerged. A big part of that is getting more regulatory clarity around, what traditional finance firms should be allowed to do, maybe guidance on expanding what they're allowed to do. I think there are a lot of interesting questions about where should things live in terms of, the debate about national securities exchanges versus ATSs, and can we foster an environment in which both have a role to play? Can we try to pull more of this trading into the U.S. and into the regulated environment in a way that doesn't impact and stamp down innovation? I think there are ways to do all of these things, and I think there are some, clear steps the SEC can take. I know for me, like I've said before, absent the SEC and CFTC merging, it doesn't mean that there can't be a really strong, close working relationship and an attempt to figure out how to learn and analyze more about these markets, and to start to think about what market surveillance might look like if there is this sort of regulated trading environment for digital asset securities. And as I think even just the ETF conversation illustrated, this need to let firms become more flexible in terms of the assets that they can custody and the assets that they can trade and places that they have to trade those. And if we can start to bring those together and certainly focus on the right kinds of disclosures to reduce or eliminate conflicts of interest, highlight areas, we were talking about before, where we have traditional disclosures in the space for execution quality and broker order routing. Those kinds of things can translate directly into this space as well. And so more disclosure and simpler rules and maybe some guidance on some of these issues, I think there's a real great path forward.
Great. Yeah, I'll just summarize a couple of the points I think we've already hit on today. I think from my perspective, and we talked about this, I think both directly and implicitly throughout the conversation, I think most people are expecting Congress to come up with the rules between securities, commodities, et cetera. I think that is, ingrained in a lot of the conversation we've had today. But for whatever reason that does not happen, I think it's an important conversation for the SEC and CFTC to be engaged in. I think that looking at how non-security and so commodity tokens can intersect with broker-dealers and other SEC-regulated entities is an important exercise, and I think that that can, further U.S. competition here. We talked, I've brought up offshore and outside of the U.S. markets a decent amount here today. I do think that it would make sense for the Commission to look at whether there are potential avenues of reciprocity with some regions, and specifically what brokers' role would be within that to basically access liquidity on behalf of institutional customers in those regions. And then the last thing I would say is just looking at a consolidation of regulators within the United States itself to make sure that we can be most competitive on a go-forward basis at a global scale.
I have a lot of similar things on my wish list. But I would just say at the very top of it, just how important and welcome the engagement and the engagement of the crypto task force and just engagement with industry, and this dialogue in particular is just sort of critically important. So at the top of my list is a continuation of exactly this kind of forum and the sort of meetings that we've had and are really advancing the state of things tremendously, and so that's greatly appreciated. On the, after that, I would say the more specific rules around reforming the special purpose broker-dealer and which would allow for the creation of an ATS with the not just side-by-side, but if integrated, I don't know. I also don't know the right word for what we're asking for exactly, but it's not the two things on the shelf next to each other. It's being able to trade them side-by-side, which is what I think the customer is going to expect as a user experience. And so really sitting and thinking about that and understanding how the rules would need to conform to allow for that, and the necessary exemptions that would come with respect to things like the order protection rule and things like that would be critically important. And then sort of lastly, I think the ability in the case, as Richard said a few times, about from a transfer agency perspective, really starting to think about using the chain as the source of truth from a record holder perspective. Those are some sort of nearer term things I think that are achievable and would help us get to a place where we can start really experimenting with the true power of what this could enable, and I think really set the United States up to the point that was made a few times, which I think is absolutely right. The United States should be the place where this innovation is happening, and I think this would get us to the starting line in that conversation.
Well, I'll echo the thanks for being here today. I think that this is the kind of conversation that the industry has been hoping to participate in, especially in this building for years, and it's a real joy and privilege to be here in such a collaborative and non-adversarial way. So I'm very grateful for that, and I've really enjoyed the discussion with all the other panelists. I would say one topic, and then one big picture thought. One topic I'm not sure that we fully dove into because it's a little beyond just crypto trading, but it is relevant, is that more record keeping and transparency and those tools or those needs can be served by the blockchain today in ways we couldn't have imagined before blockchain technology. And I think that will be increasingly true as blockchains continue to develop. So I do think that for any regulator looking at markets, we should be embracing the future of blockchain technology generally as a tool for those markets. And maybe in particular, I'm certainly not the first one to say it, but I think it's true, as a check against the potential misuse of AI in future markets as well. So that is, one more granular point that I'd love to make. But as a big picture point, again, I think it's incredible that DeFi has a seat at this table, and I'm grateful for that. DeFi is valuable technology that can and will shape our global markets for the better if we let it, and so we should embrace it. Self-custody technology is one of the most important financial tools that we can give to everyday people as a check on the risk of the traditional finance system. And so I urge the Commission and all regulators to embrace the development of responsible self-custodial technology. Thank you.
Great, thank you. It's been such a great conversation. I think, I'm pleasantly surprised by the level of agreement that we have here, despite a number of diverse opinions. What I've certainly been hearing is, there's a clear role for broker-dealer and ATS model to be able to leverage existing structures to protect investors and provide safe pathways to crypto trading. I think we had a lot of agreement around registration as well, and a path forward for that through something like a 15C to 11 type structure. Token taxonomy, let's get that straightened out. That seems like kind of an easy one to fix early on, maybe. We've been talking about it for a while. Custody as well. Greg's mentioned the special purpose broker-dealer quite a bit, and you are a qualified custodian already, and in the ATS world, we look to, the term is a good control location, so I think that's what we're probably trying to integrate there. We may be able, maybe it's the SPBD, or maybe we can leverage some of these existing structures that have been around already, like Anchorage or the state trust entities. One thing we didn't really talk about today yet is a sandbox. Maybe that's the way forward for some of these things. I'd certainly like to be able to see us, maybe that's the easy on-ramp is through kind of a SEC oversight of a sandbox. I'd love to see the blockchain as the official record of ownership. I'd love to see smart contracts being used for settlement, actually doing atomic swaps. I think a path forward for that is kind of taking this transfer agent role. And people are saying, oh, there's no, you don't need, with the blockchain you don't need transfer agents, but maybe that's what a transfer agent becomes, like a fully on-chain. Maybe the transfer agent should have, which is a regulated entity, should have some oversight over the smart contracts. And there's some things we didn't touch on. Maybe Catherine wants to keep these out of the sandbox, but things like a DEX or an AMM, is there a way to do that in compliance with Reg ATS? And the side-by-side pairs trading, trading Bitcoin against Tesla or something like that. I think these are kind of all interesting topics that we could be done safely in a sandbox. I think we'd learn a lot, and I think we'd move the space forward.
Just a couple things to close for me. I'll echo everyone's sort of encouragement or plea for continued CFTC SEC collaboration. I think, as a CFTC alumna, whether or not we merge the agencies, I do think, sort of the CFTC's principles-based approach, to regulation, I think is something that, I think is beneficial for crypto and beneficial for innovation in general. I think it offers flexibility, sort of a less prescriptive approach to regulation, I think is important. So I think, whichever regulator has sort of jurisdiction, if there is legislation or what have you, I think sort of having that principles-based approach in mind, I think can be helpful. And then just on the topic of legislation, I think, I think there's just already been so much that's come out of the task force and out of the commission just in the past few months that I think has been helpful. I would just say, I wouldn't wait for legislation. I wouldn't assume legislation will. I think certainly we're optimistic that it will happen, but it's not 100%. Everyone in this room knows probably better than I do. Like not 100% certain until it's enacted. So, if I just to the task force, I just want to commend you all on your great work and say, I wouldn't sort of put a pause on regulatory clarity while you wait for legislation. So, I know we've all talked a lot about legislation today, and it seems like we're all pretty optimistic, but. That's just my thought. And then, I also just want to echo everyone else's thanks for having us and for, just the openness to the dialogue. I think it is really refreshing to be here in just such a collaborative environment, sort of, a complete 180 from the way things, were just a few months ago. So really appreciate that. Thank you all.
I got 2 minutes. I'll be
One.
quicker. One? All right, one. No, I want to say, I think the innovation that's gone on in the crypto industry for the last 10 plus years is, there's some remarkable technologies in it that I think have potentially transformative impacts on various areas of the, sort of more established securities world, even beyond U.S. equities. I do think the thought I want to leave everyone with is, I talked about a little bit in my opening remarks, the seat I sit in, and my peers in the industry and the industry members, and many of the people that work here at the SEC have worked long and hard to make our markets, our U.S. equity markets, the envy of the world. And I think that should mean something to all of us. And the thing I'm mindful of, I think there's a lot of areas where we can improve outcomes with these technologies, with these approaches. We also need to be very careful we don't throw the baby out with the bathwater. And I say that because, there are many, many, many things that are imperfect with the current equity market structure. I did not participate in this conversation. I enjoyed listening to my fellow panelists talk about it. I'm not saying, there's nothing to change, but that is my one ask, is be very careful with that. And I think if you compare it to other securities markets, there are reasons why it is as resilient as it is as trusted as it is, and it is as liquid as it is. So I just ask that you treat it with care.
That was like 140, but I'll give it to you. If folks could just hang around for 1 minute, I would echo the gratitude. I really feel grateful myself to be a part of this conversation, especially with this great panel, and really applaud the Commission, Commissioner Peirce, Richard, and the rest of the task force for everything they've done, also under Chairman Ueda's leadership. And I think this has been a great day. So thanks, everybody. Also, everyone who stuck around. Thank you.
All right, guys, you almost get to go home. Several years ago, I was at Consensus in Austin, Texas, and I had my SEC badge. I was staff at the time. And when folks would see it, they would audibly boo me. And it wasn't like 1 or 3 or 5 people. That was the reaction that we were getting at the time. And even back then, I was working on crypto issues in the building, and I was so desperate to work towards crypto clarity. So I'm so grateful that the task force finally gets to do that. And I really, all of you commended us, thank you, along the ways. But that means so much, because I know it's not easy to come back to a table that feels like it was hostile. So we appreciate your collaboration. We've received over 100 written input submissions already. They're posted on our website. Each of those are read and considered, and we really look forward to reading more. And we're going to continue our work. In 2 weeks, just here, exactly 2 weeks from now, we're going to have a custody roundtable. We're going to continue tackling the issues that we need to get through to provide this clarity. And after that, we'll have a roundtable on tokenization in May. And in June, we'll look at DeFi. So we hope that all of you will continue to come, continue to work with each other and us, and we'll get there. Thank you so much.